It started with a sentence on a billboard. Why rent when you can own? That line sounded like freedom. It felt like the American dream in 8 words. And for a while it worked. Home prices climbed, banks got paid, Wall Street got rich. Then, on September 15, 2008, a firm with roughly $639 billion in assets filed for bankruptcy. Lehman Brothers. Gone. Overnight. Retirement accounts cracked. Credit markets froze. Millions of people lost jobs, homes, and years of savings. So how does a marketing slogan help break the world? This is the autopsy of the 2008 financial crisis, not as a Wall Street soap opera, as a money machine that turned a dream into leverage, then leverage into panic. To understand the crash, you have to rewind to the early 2000s. After the 2001 recession and the shock of that era, the Federal Reserve cut the federal funds rate hard, from around 6.5% in early 2001 down toward 1% by 2003. Cheap money flooded the system. Mortgage rates followed. Buying a house suddenly felt more affordable, at least on the monthly payment. And culture amplified the pitch. Ads, lenders, brokers, neighbors. Own a home, build wealth, stop renting. Why rent when you can own? Here's the half answer most people miss. The slogan wasn't just optimism, it was permission. Permission to stretch. Permission to borrow more than your paycheck could safely carry. Permission to treat a house like a guaranteed lottery ticket. But that's not the full story, because cheap rates alone don't create a crisis. The real fuel was who got loans and what Wall Street did with those loans. Subprime lending exploded. These were mortgages for borrowers with weaker credit, thinner documentation, or both. Some products were so loose the industry nicknamed them ninja loans. No income, no job, no assets verified, at least not in the old school way. Many loans started with teaser rates that looked cheap, then reset higher later. Now picture a family at a kitchen table. The broker smiles. The payment looks doable. Prices have been rising for years. Everyone says you refinance later. So they sign. From 1998 to 2006, according to Federal Reserve history summaries, average U.S. home prices more than doubled. Household mortgage debt jumped from about 61% of GDP to about 97% of GDP. Ownership rose. Construction boomed. For a minute, the dream looked real. Then everything changed. Or rather, the math changed. Home prices peaked around 2006. By some Case-Shiller measures, national prices later fell on the order of 30% from peak to trough. When prices stop rising, the refinance escape hatch slams shut. Payments jump. Defaults stack up. Foreclosures stack. But here's where it gets crazy. The pain didn't stay in the neighborhood. It traveled into the global financial system. Here's the core mechanism in plain English. Banks and lenders originated mortgages, then sold many of them into a machine called securitization. Thousands of loans got packed into mortgage-backed securities. Think of a giant blender. Individual mortgages go in, slices of risk come out. Investors around the world bought those slices for yield. Pension funds, insurers, banks, foreign buyers. Then the blender got more complex. Collateralized debt obligations, or CDOs, re-sliced slices. Synthetic products let people bet on the performance of those securities without owning the underlying homes. Credit default swaps acted like insurance. You could buy protection against default, almost like betting your neighbor's house burns down while you collect if it does. Rating agencies stamped many of these structures AAA. The Financial Crisis Inquiry Commission later reported that from 2000 to 2007, Moody's alone rated nearly 45,000 mortgage-related securities AAA. In 2006, 83% of the mortgage securities Moody's rated AAA that year were later downgraded. And yes, the agencies were generally paid by the issuers who wanted those ratings. That conflict is well documented by the FCIC and the SEC. So, risky loans got dressed up as safe. Safe-looking paper got sold everywhere. Leverage piled on. According to the FCIC, the 5 major investment banks were running with leverage ratios as high as 40 to 1. Tiny losses could wipe out capital.
When housing cracked, the AAA costume tore. Values of mortgage securities plunged. Nobody trusted anyone's balance sheet. Liquidity vanished. Bear Stearns nearly failed in spring 2008 and was sold with Federal Reserve assistance. Then September hit. Lehman Brothers, a roughly 158-year-old investment bank, filed Chapter 11 on September 15th with roughly $639 billion in assets and about $613 billion in debts, according to bankruptcy filings widely cited in official case studies. The next day, the Federal Reserve launched an emergency facility for AIG. Over time, combined government support for AIG reached on the order of $180 billion, according to Congressional Oversight panel and related reporting. Credit froze. Companies couldn't roll short-term funding. Money market panic spread. Congress authorized the Troubled Asset Relief Program, TARP, with up to $700 billion in authority under the Emergency Economic Stabilization Act of 2008. The Fed drove rates towards zero and later used large-scale asset purchases, quantitative easing, under Chair Ben Bernanke to stabilize markets and support the economy. Automakers like GM and Chrysler also needed rescue-scale support through TARP programs totaling tens of billions. But for Main Street, stabilization didn't feel like victory. The Great Recession, dated by the NEBR from December 2007 to June 2009, cut deep. Federal Reserve history notes GDP fell about 4.3% peak to trough. Bureau of Labor Statistics data show unemployment reached 10.2% in October 2009, with about 15.7 million people unemployed. Payroll employment had fallen by roughly 7 million since the recession began. Household net worth collapsed from roughly $69 trillion in 2007 to $55 trillion in 2009, according to Federal Reserve history. Imagine opening your 401k statement and watching a decade of work shrink in months. Imagine a foreclosure notice on a house you were told would always rise. That human shock is the real balance sheet of 2008. By 2011, anger had a slogan of its own: Occupy Wall Street, the 99%, a cultural reckoning after bailouts, job losses, and broken trust. So what broke the world? Not one billboard company, a cultural lie that made overborrowing feel responsible, cheap money that made risk look cheap, a securitization machine that hid that risk behind AAA labels, and a web of bets so tangled that when one corner failed, the whole system seized. The lesson isn't that owning a home is evil. It's that the next crisis will also arrive wearing ordinary clothes, a friendly slogan, a rising chart, a product that sounds smart until the music stops. If this money autopsy helped you see the machine under the marketing, stay with Terminal Value. We dig into the stories markets tell and the costs they hide. Thanks for watching. If you want to see more videos like this, make sure to like this video and subscribe to the channel.